And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is actually Tuesday because yesterday was a holiday for the markets, and markets were closed all day yesterday. So markets playing a little bit of catch up to the news that happened over the weekend. We'll get into all that in a second. But outside of that, again, we're going to get there. We're also about to move into really the heart of earnings season this week. Beginning this week, we're going to start, last week was a lot of the major banks, JP Morgan, Wells Fargo, BlackRock, Goldman Sachs. This week actually starts the beginning of the rest of the S&P 500. We're going to kick off, and then next week we're going to get into all the mega cap earnings, Apples and those type of companies. So this next 2 weeks are going to be very, very packed with corporate earnings. That's going to be really kind of driving the markets a whole lot here over the next couple of weeks. Expectations right now still very elevated. So far, I love this fact set piece out this morning. With 7% of the companies reporting earnings so far, we have a 78% beat rate. So we're all excited. 7% have beat earnings. That's great. It's all good. Revenues have come a little bit shy so far, so we'll see if that trend continues or if that was more of just a finance sector specific area. But you always got to kind of spin things positive. Earnings so far, so good. But really, it's a lot of these earnings will come in the next 2 weeks. By the end of next week, we'll have about 80% of the S&P 500 will have reported as we wrap up the month. Also, corporate buybacks. One of the reasons the market's been fairly weak here as of late is that we've had no corporate buyback activity. We've been in blackout. It's starting this week and really next week, those buybacks will start to come back. So by the time we get into February, we'll have a lot of buyback activity, kind of really back into the markets. That should help provide a bit of support. So that's really kind of the backdrop so far. But of course, the big news over the weekend was President Trump, making basically the claim that he will impose tariffs on Europe over this whole idea of the acquisition of Greenland by the U.S. And this has sparked a lot of concerns globally, and why, I'm not so sure, but the media has just gone, kind of AWOL over the weekends, going, these tariffs are going to be terrible for the world, and it's going to cause this to happen. And have you not learned yet that President Trump does this to negotiate a deal, just as we've seen in every other previous tariff episode? Do you remember Liberation Day, where he stood up there with the charts with 50% tariffs on this company and 28% tariffs on this country, and that didn't happen. They wound up negotiating deals. The tariff rate came down dramatically. Yes, are there tariffs in place? Yes, there are, but they are about where the expectation was going into the tariff announcement. But this is how President Trump negotiates, and why the media has not learned this as of yet, by just saying, President Trump announced tariffs over the weekend that nobody actually believes will actually be the case. But hey, we'll kind of wait this out and see. Look, there will be a deal done of some sort. Either he will get a deal done with Greenland or he won't. And there may or may not be any tariffs at all on Europe. So I wouldn't go out making major bets in your portfolio based on something that is very much in flux right now and that the markets are going to start to price in very quickly. What do we know about tariffs so far? What we know about tariffs are two things. One is that they don't have the inflationary impact that everybody was so concerned about last year. In fact, inflation is expected to decline further as we get into the year. Secondly, it has not impacted corporate profitability. And again, what's the one thing that drives markets going forward? And that is the outlook on corporate earnings. So we've already had all these tariffs, and right now we're talking about earnings and corporate profitability at record highs despite tariffs. So tariffs did not have the impact that was expected previously on the one thing that drives the markets over time, which is forward earnings expectations. And as long as forward earnings expectations remain elevated, and they are, markets should continue to do well. However, we are going to have a bit of a correction today. Markets are looking down right now in the Dow, down about 600 points. S&P is going to be down about 2%. NASDAQ's going to be down about 2% this morning. That's not surprising. We have these corrections for a while. We talked about this last week, is that markets were getting, kind of a bit elevated here. We've had this kind of consolidated pattern. We'll get into this in just a second. But that correctional process is a normal process in the market. And this will likely turn out to being buying opportunity for investors to buy things a bit cheaper here. Got to let this kind of work through for a few days. I wouldn't, try to, buy the market today. But again, this is going to kind of be that process we're working through. But anyway, so technically speaking, let's talk about what you need to know before the bell this morning. So as I said, the markets, and we talked about this last week. In fact, I think it was on Thursday last week that we talked about this kind of rising wedge pattern that we have in the markets, and that price consolidation was going to break out one direction or the other. And it said if it broke out to the upside, we could go to 7,100. If we break out to the downside, we're going to have a correction. Well, today we're going to break out to the downside of that. And that really kind of brings the target of either the 50-day moving average at 68.10 right now for the S&P, or the 100-day moving average at 67.20. Both of those are really kind of the next levels of support to pay attention to in your portfolio. But again, somewhere in here, the market's likely going to find some footing. It's unlikely we're going to have a much larger correction, but 2, 3, 4, 5% correction, that is not abnormal at all for the markets. Happens every year. And that's something we're going to kind of continue to work through. But volatility is part of the investing process over time. So just be aware of it. And this is why we talked about rebalancing risk, taking profits, do those type of things that we discussed last week, because that was the risk that was building. We are going to trigger a momentum sell signal today. We are going to get pretty decently oversold after today's actions. We'll be able to update you on that tomorrow. But again, that does apply, this break of this consolidation to the downside does apply some downward pressure to the markets. We may get a couple of days of selling here, really kind of across the board. And again, this is really just not, not anything surprising, not anything that you should, go, oh my gosh, this is the beginning of the next major crash in the markets because of this. It's not. Markets are going to see through this very quickly because of two things. One is does this announcement, and even if we apply tariffs to Europe of 10%, does that impact the forward earnings expectations of companies like Meta, Microsoft, Google, Apple, those companies? No. Does it change the dynamics of the economy here in the U.S.? No. So with those two things being no, it's very unlikely that this market's going to have a much bigger decline over this, and more importantly, the markets are going to see through this very quickly, and they're going to step in and start buying here. And now where they start buying is unknown yet. But again, we've talked about this before, is that the reason you have big sell-offs in the markets is because you get to these levels in markets where there's an imbalance of buyers and sellers. There are buyers in the market. They're just a lot lower right now than where sellers were willing to sell a few days ago. So sellers having to catch up to where the buyers actually are today. And that's why markets will be down fairly sharply this morning. But again, we'll see kind of how this day ends, and we'll have a much better idea tomorrow. So again, don't knee-jerk reaction to the market today, this announcement. Let this kind of work through for the day. Let's see where we wind up tomorrow, and we'll have a better idea of what to do next. Okay, that's what you need to know before the bell this morning. Let me transition sets here. We'll come back with John Penn. Be right back for Two Dads on Money.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning and welcome to Two Dads of Money. John wasn't here last week. He was being lazy. So,
I was not being lazy. Even though I wasn't here last week, I worked the whole week. I worked the whole day, as usual.
well, I know, but I was working too, but I was also here. I wasn't, home because I had a little sniffle.
Well, I didn't want to risk getting y'all sick.
Well, we're glad you're back.
Thank you. I'm glad to be here.
So, did you have fun this weekend?
I did. It was a great turnout.
Right. So, if you missed it, we had our economic summit over the weekend and had a really great turnout for it. The event was really good. We had a lot. I was surprised how many people came in from all around the country. We had people from California, Montana, Florida. I mean, it was amazing.
Colorado, Arizona, even a lot of the younger generation was there too. There was actually a couple, a dad and brought his, young son, 18, about to go off to college, brought him to the event. And so it was good to see some younger faces in the crowd too.
Yeah, no, it really was. Anyway, it was a great event, and I hope y'all were able to come and enjoy it. In the next few days, we'll make the presentations available. So we'll probably have a download link somewhere on our website, and I'll tell you when that is. So if you want to get a copy of the presentations that we're able to provide you, again, we're communicating with BlackRock and DeFi Development whether or not they can provide their presentations just from legal and compliance standpoints. But as soon as we have kind of everybody's approval, we'll get those presentations, ready for you. Just the PowerPoints, right? And so you're not going to see the whole conference, all the speeches that went along with it, but we had a lot of requests for the slide deck. So we'll try to figure out how to make those available for you. All right, so a couple things to catch up on. We're playing a little bit of catch up from last week on today's topic, which is housing a good investment. So we'll kind of pick up on this, but a few of the things that are kind of going on also right now. Just we're kind of coming back into the second semester of college here. So kids are all getting back to college right now, rushing for sororities and fraternities and all that type of thing. So. This is where, I'm starting to get a lot of emails now talking about, kind of this, we kind of touched on this previously, is like, hey, I'm in college right now, but I want to start investing, and that's good. We're seeing a lot of Gen Zs now, and there was actually a really recent graph that just came out. I posted this on Twitter a few days ago, showing that Gen Zs are now the most invested of all previous generations. In other words, at their age, more of them are now getting invested to the markets. And it's interesting that these kids are in college, and I'm getting these emails going, hey, I want to get invested. How do I do that? And that this is a great first step, and this is where it's also important not to screw it up. So,
true.
And so again, kind of the caution here is be a little bit careful with risk taking. Kind of in this market. One thing that investors, and especially young investors, mistake time and time again, is getting greedy and taking on too much risk and chasing assets that are already very elevated in price. And high prices are a cure for high prices, and so just be careful with taking that speculative risk. It's fun, and it's exciting, and it's kind of a game right now. And too, with like Robinhood, for example, we kind of gamified a lot of investing and made this speculative attitude kind of in the markets a very easy process. So yes, invest in the markets, but do so with a little bit of base in there. In other words, invest in some boring stuff. Just buy an S&P index fund, and then if you want to speculate a little bit, take 20% of that and invest in more of your high-risk assets. And that way, if something goes wrong, it doesn't completely destroy what bit of savings that you're already trying to accumulate.
Yeah, so I noticed this too. A lot more interest from younger investors wanting to get started with the market, and just when I'm visiting with our clients, moms and dads, and the ultimate compliment that I can get as an advisor is to be introduced to a client's son or daughter. It's amazing, and so we're having a lot of conversations around, as kids are coming up through school, and they're working in school, so they have wages, they have earned income. What can they start doing at an early age to really start getting a kind of a head start with investing? So we have a lot of those same conversations, Lance. And even when kids, when you're in school or coming out of school, before you start investing, and this sounds so basic, you want to make sure that you have an emergency fund set up, right? I mean, I go back and look at the emergency fund that I had when I was in school. You want to make sure you have a good 3 months at least of just what does it cost for you to live, set aside, Maybe it's 3 to 6 months, depending on your situation. And then from there, then you can start investing more for the long term, right? And I can't stress it enough. When you're young and if your earned income is a lot less, Roth all the way, Roth IRA. Take a look at a Roth IRA. And I was talking with some moms and dads last week where their children are younger than 18. You can actually open a custodial Roth IRA for them, right? So get that, if they have earned income, open up a custodial Roth IRA, get money invested in there. And like Lance said, you can keep it very simple, very straightforward. Just start investing in like a Standard & Poor's 500 index fund for the long term. But then if there is that itch to kind of speculate a little bit, maybe it's 10, 15, maybe 20%. Off to the side if you just feel like you need to speculate, so that way if you do and if it works, great. But if you speculate and if it doesn't turn out the way you anticipate, it doesn't derail you.
Right, exactly. I'm just kind of paying attention to chat right now, and I see where the real problem is when we're talking about these topics. We have several requests for us to get beers out of the fridge for our chat members. Oh. It is 6:15 in the morning. That is a problem.
Is it 5 o'clock somewhere?
That is a problem. At 6:15 in the morning, you're wanting beer out of the fridge. So, yeah. And the fact that somebody said our kitchen was hideous is probably correct. But, I don't get to pick the sets in the morning. So, anyway. This is just kind of, we're kind of getting back into the swing of things. And here's another thing you don't do. I got a question about this over the weekend. Is don't invest your student loan money. No.
No.
So there was a question. It's like, I've got the student loan money, and when if you're not familiar, when you apply to Sallie Mae as an example to get a student loan, you can take out extra capital. So it's not just for the tuition of college. You can take out extra loan money for things like a computer, travel back and forth to school, those type of things. So they will give you extra money. You just tell them, say, hey, I need a new laptop every semester. They're going to give you like $2,000 every semester for a laptop. But no, don't take that money at 9% interest and invest that into the markets, because if you lose, it seems tempting, right? It's like, I can get this free money from Sallie Mae. No, you've got to pay that back. It may be a $25 a month payment right now on that money. That may seem cheap, but that interest is accruing in the background. And if you invest that capital and lose it, which is probably going to happen, you're going to be a lot worse off than if you would just not do that. So. Yeah.
Yeah, or if you are taking out student loans, sometimes the interest you start paying those loans, let's say 6 months after you graduate. But if you can just at least make some interest payments along the way, it'll make those payments a lot more manageable when they do start 6 months after you graduate. And you may look at this and go, I've got several years, I've got plenty of time for that to start. It happens so fast, right? So even if you're deferring the payment of your student loans, at least try to make some payments while you're in school along the way. Moms, dads also talking to you, have those conversations with your children. So that way when those student loan payments start after graduation, they're a lot more manageable and you don't get the big surprise, right?
Yeah, exactly. All right, so I've gotten a bunch of emails. We were going to touch on this topic last week, and then like I said, John was just being lazy. He wanted to sleep in. I got several emails. It's like, I want to buy a house as an investment, right? Now, there is two very specific facts about investing in real estate. And the question is are you going to live in it or not? And that's really the defining question. So that was my question back to them. Is this a house you're buying to live in, or is this a house you're buying to rent out? Because if I buy a house to rent out, okay, that's an investment. If you buy a house that you're going to live in, that's not an investment. So what we wanted to touch on today was a little bit about that. And there's a question in the chat this morning, our poll question for the day in chat is, is a house a good investment right now? And the question is yes, if you plan on staying long term. Depends on price and financing. No, better to rent for now. And not an investment decision at all. So go vote in that poll, and we'll kind of talk about this a little bit along the way.
So it's probably a good thing I did stay home last Tuesday morning, and I was up at the crack of dawn listening. I just wasn't here. Yeah. But so talking about kids in college, I'll tie this all together in a moment. So our youngest daughter just graduated from college this past December, right? And she's been with us because she's been living with us for the last couple of years because where she goes to school is very close to where we live. So she has commuted back and forth, and she has helped mom and dad save a little bit of money on some room and board. So I was not here in the studio last Tuesday. I was working from home last Tuesday morning, and when our daughter came down to head out for work for the day, she said, "Dad, there's water on the ground upstairs in the upstairs laundry room." And I said, "What?" So I walked up there, and there was a puddle of water on the floor in our laundry room, and I looked up, and there was water dripping down through an exhaust vent in our ceiling.
Okay.
And I thought to myself, well, that's not normal. So I went up to the attic, and that's where our tankless water heater is. Mm-hmm. And one of the return lines underneath there just decided to crack off. So I had water dripping from underneath that tankless water heater down into the catch pan. So the catch pan was doing its job. The only problem was the catch pan wasn't connected to the drain that runs water outside the house. And when our house was built 6 years ago, the builder didn't catch it, our inspector didn't catch it, and I didn't catch it. I would have never thought to look at that. So just, I guess the moral of the story is there is always something going on when you own a house. But I would just say, as a word of advice to everybody out there that's either thinking about buying a home or upgrading to a home, whatever it might be, double check your catch pans. I'm just telling you right now, double check it. I will never make that mistake again.
Yeah, no, absolutely.
It could have been a lot worse. But I was home last Tuesday, so we caught it in time, so the damage wasn't so bad.
Yeah, but it's not even that, though. You have to check your catch pans on a regular basis.
On a regular basis.
And again, not like every week, right?
Yeah.
That type of thing. But, maybe once a year, go throw an eyeball on your catch pan up there because, it collects dirt, dust, lint, whatever, and then the water drips in there and it creates a little ball and it kind of floats over towards the outlet that goes to supposed to go to the outside of your house, clogs that up.
That's
and then
right.
all of a sudden your drain pan overflows, you've got water coming from the ceiling,
Yeah.
and you just don't want those things. So
yeah, I saw it dripping down through the exhaust vent, and at first I thought, well, we got warmer air inside. It's cold in Houston, right? So I thought I had some condensation. It was leaking back in. Then I looked up at the ceiling and I saw paint starting to bubble on the ceiling. I was like, oh,
yeah, it's not good.
That's not good. And immediately, the first thing that comes to my mind is, how much is this going to cost me, right? It's just like you just see dollar signs. So it's when it comes to a house, it's as we'll get into here in a moment, it's not the mortgage payment, it's everything else.
Yeah.
It is everything else. And there's always something when you own a house.
Yeah.
It's never a dull moment, right?
Well, I think more to the point of today's story is that I read this article, and this was actually an article that was published out in the early 2000s, and this was right after Alan Greenspan started really pushing adjustable rate mortgages and saying everybody needs to buy a house and we need to do these adjustable rate mortgage because your house is an investment. And this is one of the things that financial advisors have done, I think, and not you, John.
Yeah, sure.
You're the only good one out there.
Thank you.
But I do think this is one of the things that the financial advisory community has done a very, very poor job of. And we do this a lot. And in fact, there are recent graphs that show the net worth of individuals in the U.S. And the net worth of U.S. individuals has been climbing steadily over the last few years. It's doing great, right? But that includes the value of their house. Yeah. And we start looking at the house as part of your net worth. And the problem with that is that your house is not liquid if you live in it. And we've talked about this before on the show, is that one of the mistakes we make is like, oh, I have all this net worth. This is great. I've got I bought this house for $250. It's now worth $1 million. That's fantastic. So I've got all this net worth sitting there. Okay. The problem is now you've only got two ways to access it. A, you sell the house, so now you've got your $750,000 in profit. So now you're either forced to rent, because if you go buy another house, what's the other house going to cost you?
Yeah.
It's going to be $1 million, right? Because every other house has gone up. We're using facetious numbers, but every other house has gone up in value too. So if you buy your house and then sell it, and you've got capital, great. You've extracted the capital from the house, but now you've got to have a place to live. So if you go buy another house, well, you've got to spend that. You no longer have that money, right? It's now invested in the new house. You could go rent, but now you're stuck renting permanently if you want to maintain that liquidity from the sale of the house. Or you can go take out a loan against the house, like a HELOC or something like that. That's great, but now you have debt. So the point of the story is that be careful with this narrative that your house is part of your net worth, because yes, it is technically part of your net worth, but when we're talking about investing and growing wealth over time, don't look at your house as part of that puzzle, right? Because again, in order to access it, you've got to sell it, and then you've got basically 3 decisions to make: go into more debt, rent forever, or basically just repopulate that money into a new house, and that's where you are. So, part of, building financial net worth is building financial liquidity, and that you have access to. So yes, I own my house, which is not an investment. It's an ongoing expense forever. We've talked about that previously. But think about things like, okay, I need liquidity to live on. I need to maintain my house, right? I got to have my annual. I just paid my taxes, by the way.
Yeah, my check's going out this week.
Yeah, mine went out last week. That wasn't pretty. But you've got your annual taxes, your HOA fees. You've got your ongoing maintenance and upkeep. So you need another pile of assets over here to supply the income to support. And we're talking about retirement now. Eventually, when you retire, to have another pile of assets over here that are liquid, creating an income stream to pay all those housing expenses so you don't wind up losing your house.
Yeah, it's the discussion around homes and how these fit into a financial plan is something that I talk about with clients on a very regular basis. Mm-hmm. We don't, when it comes to looking at model or building in real estate within a financial plan, and there's different types of real estate. There's your primary residence that you're living in, right? And yes, I think it's still part of your overall net worth. It's part of your balance sheet. But we typically don't tell the financial plan, well, we're going to assume that these assets in the house are going to be used to, pay for certain goals and expenses like vacation or your basic living expenses, et cetera, because the house is an illiquid asset. Now we can definitely model this though. Let's fast forward, 10, 15, 20, 25, 30 years down the road. If somebody should need higher cost of care, long-term care, medical assistance, whatever that might be, if somebody is concerned that they may need to move into an assisted care facility or a nursing home, then we can always model selling that primary residence to create the liquidity, to create those pool of funds to then support that need. Or, and Lance already mentioned it, there are times where maybe exploring a home equity line might make sense. We just have to see how it fits. Or we can also model, would it make sense to look at a reverse mortgage where you can use the equity in your home to be a source of recurring liquidity for your situation, right? But whenever we're modeling these in financial plans, we really don't look at the home as the primary residence as, hey, I'm going to buy this today and I plan to sell this 5 to 7 years from now or 10 years from now to really support my retirement goals. It is part of the balance sheet, it is part of net worth, but we're not using the primary residence as an investment vehicle.
Right, and I think that's the mistake that a lot of young people right now are rushing to buy a house because they're being told that, and again, this is the National Association of Realtors, it's a massive lobby for the U.S. government, but they're telling, they're telling young people, it's like, oh, you need to own a home, and you need to go, this is a good investment, invest in your future by buying a house. Even Alan Greenspan made this same point when he was promoting adjustable rate mortgages, is that a house is a great investment, and it is as long as you understand there is no liquidity to it.
Right.
And your options for liquidity are very limited. Now, again, we're not talking about rental properties. Those are investments, and if I'm going to buy rental properties and rent those out and create an income stream, those are good investments. And this is the interesting point, right? Everybody's running around right now. There's a lot of commentators on YouTube talking about there's going to be a housing crash coming. Going back to basically 1960, there have only been 7 years where housing prices were negative. 2 years of those were in 1990, 1991. The other 5 of them were from between 2007 and 2011 during the financial crisis. Outside of that, every single year home prices have gone up. And that's because of inflation. Real estate goes up. Basically, and housing prices used to grow at the rate of inflation. If you look back through history and you track housing prices versus inflation, really up through 2000, they grew at about the rate of inflation. There weren't these big wild swings in housing markets and spiking gains, those type of things. What created the problem of affordability, quote unquote, over the course of the last 20 years has been monetary interventions, right? Zero interest rates, adjustable rate mortgages, no money down mortgages, all these type of things that to create an artificial demand. I shouldn't say it's artificial, that's not a true statement. It created actual demand through an artificial means by supplying buyers with a narrative that you should go buy a house, that you're responsible for buying a house, and you can now do it at a very low cost. And so that's created the supply-demand imbalance in the real estate market that's going to be very, very tenuous to fix because nobody wants to lose here. Young investors don't want to buy a house then watch it go down, right? So this is one thing. The people that own houses right now don't want to take the hit.
Yeah.
Right? So they're not selling. So we have this kind of supply-demand imbalance where supply can't really come to the markets at the moment because, again, I'm not sure that I can sell the house. At the same time, and you take a look at the actual supply and demand of houses and what moves housing prices, there's effectively nobody buying or selling houses right now. It's very, 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 very slim in terms of what's happening on a nationwide basis. But people aren't willing to sell because they don't want to pay for a higher. I sell my house today, I've got to go get a new mortgage, right? So I don't want to. I've got a 2% mortgage now. I don't want a 6 or 7% mortgage on a new house. And people that are buying a house saying, well, I don't want to pay that for a house and I don't want to pay that for the house plus the 7% mortgage. So everybody's kind of in this stalemate. Housing builders aren't willing to build in this environment, so we don't have supply coming into the markets into a great degree that if we had a supply-demand imbalance that would bring housing prices down. We don't have that. We've got a standoff right now between buyers and sellers in the markets.
Yeah, there are a number of folks that have been in their house now for a while. Like they have a mortgage rate of 2.5%, 2 3/4. They would really like to downsize, but they don't want to give up that rate. And maybe their house isn't fully paid off, but there's quite a bit of equity in the home. But if they sell their home, there's not quite enough equity to go buy something outright to pay cash. So then they look at this and go, well, why should I give up my 2.5%, 2 3/4 mortgage to go get a 6% rate or whatever, right? And builders are getting very creative. So a lot of your home builders, they are, of course, they're wanting to move inventory, right? So you look at a company, and I'm not trying to pick on them at all, but builders, one in particular, like D.R. Horton, they're trying to get very creative with offering or enticing, luring in buyers with like their own financing at lower rates. Yeah. Like right now, there's an advertisement with D.R. Horton where 3.99% mortgage plus $7,500 towards closing costs. Sounds great, right? But maybe if you're a first-time home buyer, it looks great. The math goes, well, why should I go out and why should I go out and take a 30-year note at a little over 6% where I can just finance through D.R. Horton directly at 3.99? Again, I'm not picking on D.R. Horton. A lot of your builders are doing this. D.R. Horton, Lennar, probably KB Homes,
Toll Brothers,
right? So, but it's. So you go in there and you look at that lower rate, but of course, what's the builder going to do? They're going to raise the price of the house, right? They're going to raise the price of the house, and so then as soon as you close on that, you're paying too much for a house, and all of a sudden you're upside down right from day one. So you really got to watch that. You just got to really be careful with the math around that. So even builders are getting very creative with trying to lure in those first-time home buyers because there's go out there and pursue that American dream. I would rather see folks be patient and rent a little while longer. There's nothing wrong with renting. Just rent. Put a cash along to the side, and then when it really makes sense, when you really find the home that you can afford and it really fits your budget, because too many times I see it's it's like Lance and I were saying earlier. It's not the mortgage; it's everything else. It's everything else that you have to account for when buying a home, and it's not just the down payment. I mean, there's a younger couple here just a couple months ago. They were saving up for their first time home, and I was going through their budget with them. They've done a really nice job of budgeting how much they're going to put down for a down payment. And my question was, well, how much have you budgeted for furniture and window furnishing, window treatments, and all these things that come with a first time house? Luckily, they had pre-planned, they had all that ready to go, but a lot of folks don't. They don't think that far ahead. They get the down payment on the house, and then they're cash strapped.
Yep.
Right.
Well, we saw this during the COVID lockdown.
Yeah.
Where we were sending checks to households. Everybody would get this $1,500 check. And we saw a big surge in home buying at that point because people had cash to spend for that. And all of a sudden, I've got my down payment.
Yeah.
And by the way, interest rates were cut to zero by the Federal Reserve. We had, the mortgage rate was extremely low, 3% on the mortgage rate during that period. So everything was primed for people to go out and buy houses. And we had this big surge in home buying activity. And people were competing to buy mortgages. They were willing to overpay for the value of the house, and like, oh, the house is listed for $750,000. They'd go in and offer $1 million to try to get this because they were competing to get this house. And in fact, there was a whole bevy of very young investors that were, or individuals. I shouldn't say investors; that's the wrong term. But young individuals going out buying houses sight unseen. They were simply just going on the computer and looking for houses that were somewhere in the neighborhood they wanted to live in, and they were just buying these houses sight unseen. Well, they were very disappointed when they got to the house and figured out that there was a lot of problems with the house, that it was in the general area of the neighborhood they wanted to live, but it wasn't a good part of that neighborhood. A whole variety of things came up from this activity, and it was a very disappointing outcome. And plus, they, to John's point, they had the money for the down payment, but they didn't have the money for the closing cost, and then for the moving cost, and for the all the other things that went on with the house following that. They got themselves into a lot of financial distress very quickly because they just kind of went into this process sight unseen because the media was telling them that they needed to buy a house. And as we've talked about before, houses are great. I own a house. John owns a house. They're fantastic. We don't own our houses. We never will own our house. But they're great, right? So you can say, I've got my house and I've bought my house. It's fine. And again, but just go in this with your eyes wide open that you're going to move into the house. Then immediately you're going to have a whole lot of cost of just the things you didn't even think about. Oh, we moved in and I've got to go buy, the house didn't come with a refrigerator. I have to go buy a refrigerator. I need to go buy a washer and dryer. I need to go, I need to buy all these other things that I didn't plan on before. And now I'm getting into debt more because I have to go buy these things now. And then, of course, yes, you get the forbearance on your property taxes for the first year because you pay them at closing. And then the property tax bill comes, the HOA bill comes, and you've been kind of strapped all year long just making ends meet. Homeowners insurance, all those type of things. And it's like all of a sudden you're getting all these bills coming in. It's like, I don't have the money for that. And so this thing can get very sticky very quickly. And this is why it's really important. And we touch on this a lot is that, this is a big commitment and it can have a really big impact on your financial future. And I don't know why there's such a rush by young people to go out and buy a house. There is no rush. I told my wife the other day, our house got struck by lightning, and I go, there's a reason I like renting. when we were in a rental property, while my wife was building, remodeling the house that we're in now, that house had a bad electrical problem. It had a whole big, almost electrical fire. And I just called the landlord and said, hey, you got a problem with your house. And it didn't cost me a thing. And there is a peace of mind to that we're so tied up with this idea that we have to own a house, we forget about the value of the money that we have that we're pouring into that house. And again, it's always interesting. People go, well, I bought this house for $350 and I sold it for $500, and they'll go, great, how long did you live in it? I lived in it for 15 years. And then you start backing out property taxes for 15 years, HOA fees for 15 years, maintenance and upkeep for 15 years. And all of a sudden, that profit margin you thought you had really isn't there. All you did was prepay the profit margin down the road. And so, yes, you've got money in your pocket today. And again, we've talked about anchoring. The anchoring effect is that these are big purchases. When I buy them, I can tell you the exact price of my first house when I bought it and sold it, right? You just remember these things because these were very big, important life events. You probably can't tell me the cost of your first hamburger. Well, my father could. It was always a nickel. It didn't matter what it was always a nickel. But you get the idea. We anchor to these big things. We can remember the buy price. We can remember the sell price. We don't remember all the stuff in between, right, that happened. All the costs, expenses, the upkeeps. And I've never owned a house in 60 years of living that didn't have problems along the way of some sort. Something happened, right? Leaks, freezes, drain pipes, whatever.
Yeah, you just walk in and you see something and you go, oh man, that wasn't there yesterday. What's going on? And just it's, I will say, so yes, so we own a home. So we purchased this home about 6 years. We were very lucky. We didn't time it this way. We were able to close on this home literally about two weeks before everything went into shutdown mode with COVID in 2020. So we've owned it for 6 years. But just after 6 years, if I go back and look at just property taxes every year, homeowners insurance, we live in a floodplain, so I have to carry some flood insurance on it too. I mean, these are all expenses above and beyond just the mortgage payments. 2 years ago, the company that I was using for our homeowners insurance, when I got the quote for what my premium was going to be for the next year, my premium for my homeowners insurance went up by 75%. Crazy. So let alone I'm not using them anymore, right? So it's you always have to do your homework too about who are you using for coverages, what are you paying, and just so you can always just watch your bottom line. So again, it's not the principal and interest, it's everything else. And yeah, right, you're right, Lance. You look at a home ownership where somebody's owned a home for maybe 10, 15, 20 years. Yeah, your home, if you're fortunate and maybe you bought in a great location, because location means a lot when you buy a home that you're going to live in. But when you look at owning that home after maybe 10, 15, 20 years, yeah, the home may have appreciated in value, but are you really ahead, or are you break even, or maybe you're still underwater just based off everything else that you had to just pay to maintain and take care of your property over that long period of time, right? So again, and I'm not saying don't go out and buy a house. That's not what we're saying. It's just that before you make the decision, you really got to take this all into consideration and just make sure that you're just not leaving yourself too thin from a liquidity standpoint, because too many people find themselves in that situation after they buy a house.
Right. Exactly.
Yeah.
So anyway, look, we've touched this topic before. I think the key takeaways from the conversation today is look, buying a house is a great idea. It's just a responsibility.
Yeah.
And it's a financial cost. And you shouldn't go into this if you're younger. And look, if you talk to anybody that's older than you that have owned houses, they're all going to tell you the same thing. Buying a house is a great thing, right? It's your home. You can do with it what you want to a degree, because you got to deal with the HOA. You just can't do anything you want. But if you can, home ownership is a great thing, and we're certainly not discouraging it at all. But what we are saying is go into this with your eyes wide open. Is that this is not something you should rush into. And it is something that you should financially plan for. Save up a 20% down payment. Now that sounds like a lot, right? But there's a major factor of importance with saving up that 20% down payment. And the reason is this: is that if you can do what you're doing now, you're renting an apartment and you're working, and you can start shoveling away some money and set up a savings account for that 20% down payment. And I can save up that 20% down payment over time, fantastic. And at the same time, you also have to still be investing and saving, right? Still contributing to 401k. You can't just solely do this. This is a new account, so it's a new savings stream for you. So you're going to put $200 a month into this account, $500 a month in this account, whatever you can afford to start saving up for that down payment while you're still paying for all your current expenses and while you're still saving for retirement. The reason for that is that's helping you form the discipline to create cash flow. Because once you own the home, you're going to need that ability to have extra cash flow for all the things that go on, the taxes, the payments, the maintenance, the upkeep, all those type of things. So if you can afford your rent and continue to save for retirement, don't change that structure. That's still the most important thing. and then start saving for this 20% down payment, and you can get there, a couple of things are going to happen. Now you're ready to go buy a house, right? So now I go buy a house. I can put that 20% down. So now I have good skin in the game. I can lower my total amount of my purchase price, et cetera, by that amount. So my monthly payments are going to be a bit lower. But I've got some good equity in my house right up front already. And I also have that discipline of saving excess money every month that is going in there. So now I free up the rent side over here. So let's say that I was paying $2,000 a month for rent, and now my new mortgage payment is $2,500. I'm just making stuff up. Or even let's just say it's even, right? Mm-hmm. My rent before was $2,000. My mortgage payment is now $2,000. It's an even swap. Perfect. So now all that money that I was paying for rent, guess what? I now have that cash flow going to a monthly mortgage payment, and I still now have excess cash flow because I've been in this habit of saving up an extra couple $100 a month, $300 a month, $500 a month, whatever it was, for that previous what was my down payment on the house. Now I can save that for maintenance, upkeep, taxes, all those other types of things, so I don't get myself into a financial bind. And so immediately, normally when I say it's like, hey, you need to save up a 20% down payment, I get a lot of pushback. They're like, oh, that's impossible. Nobody can do that. Well, if you can't do that, maybe reconsider buying a house because of all the stuff that goes along with it. Just continue to do what you're doing and then figure out your cash flow problem that you have now, why you can't save up that down payment, right?
Yeah, and if it just takes you a little while longer to save up that down payment, so what? So be it. Just rent a little bit longer. That's okay. Make the move when it makes sense for you from a financial standpoint. I mean, I'm already looking at all the headlines this weekend. What's come to my mind? There's supposed to be a freeze coming to Houston, so I already been thinking about I got to wrap pipes and cover my plants, and then there's going to be a replacement cost just for plants. Just that's extra money that's going to come out of my pocket too. So it's all these things that I think about. I just see dollar signs everywhere when it comes to a house. It is a love-hate relationship, I'm just saying.
It is. And my wife will be out there this Friday covering up all the fake plants in our front yard.
Fake plants. So look.
She can't grow anything. Everything she tries to grow, she's got a brown thumb. I love her to death. She's awesome. She can't grow plants. So finally I convinced her. I said she wanted some flowers, and she has these pots outside our front door. I said, honey, just put some fake flowers in it. From the street, nobody can tell the difference.
That is true.
And she did, and they look fantastic.
They probably look fantastic.
They look fantastic, and all she's got to do is just cover them up.
Yeah. So this weekend, so my
Don't
wife.
Don't tell her I told you that, by the way.
So in our backyard we have a lemon tree, right? And when it comes down to either the lemon tree or me, with my wife, the lemon tree wins. Right, so I know I'm going to be out there wrapping that thing and keeping it warm because we cannot sacrifice the lemon tree. So that's what I'll be doing this weekend. Because if the lemon tree doesn't survive the freeze this weekend, I won't hear the end of it.
Oh, I know. No, I bought. So when my wife first went to work at her new job where she is now, I bought her a money tree. And there's a specific tree. It's called the money tree. And if you buy this tree, it has a very unique root structure or trunk structure to it. It twists as it goes up, so it's very cool looking. And anyway, it's called a money tree. It's supposed to bring you good luck, help bring you wealth and prosperity if you own this tree and take care of it, and it grows. And so when I bought it for her, it was maybe about 1.5 feet tall, right? And this thing has grown tremendously, and it is now, and it lives outside normally. It lives outside. But now it's in the middle of our laundry room. So when you walk into our laundry room right now, it's like a jungle in there because of this massive money tree. Because she won't leave it out. It's just like as soon as there's any hint that there's cold weather coming, that thing has to come inside. So
that is fantastic.
Yeah. Anyway, but she's afraid to death of killing this tree while she has her job because so far her job is doing really well. Got to keep the money tree alive. Got to keep the money tree going.
Got to do it.
I don't know if there's anything truth to it, but hey, it seems to be working. So anyway. All right, that wraps up the show for the day. Thank y'all so much. I hope that y'all had, that if you came to our conference over the weekend, I hope you enjoyed it. It was a lot of fun. But again, we'll try to make those presentations available as soon as we can. Outside of that, kind of keep a watch on the markets today. We'll see what happens. I'll update you tomorrow on how today works out. Again, it's going to be a little bit of a rough start this morning, but we'll pick up tomorrow and see where we are. And again, tomorrow will be live Q&A with Danny Ratliff, so we'll get into all your questions and answers tomorrow morning. So we look forward to seeing you then. All right, have a great day. We'll see you back here on the next edition of The Real Investment Show. Be sure to hit that like and subscribe button. Helps us a lot, and we'll see you tomorrow.